Hi, I'm Pete Andresen with Andresen and Associates, and today the Federal Reserve did something that indicates the high probability of something miraculous happening. The Federal Reserve issued a statement on July 31st, 2024, that they're going to probably be able to do an interest rate cut in September, during their September meeting. Now, that's not a sure thing. It's absolutely not a sure thing. We don't really know what's going to happen. But so far, they've managed to tame inflation, largely. I mean, not entirely, they aren't done yet. But what they've really managed to do is something miraculous. And I can't find any examples of this kind of thing in the last 60 to 70 years, and that is a soft landing. That means that the Federal Reserve raises interest rates and curtails the money supply and slows down the economy, curtails inflation, and does not slip into a recession. All the signs are that that's going to happen now. I think there was a false alarm that could be considered a soft landing if you're optimistic in the 1990s, but the bottom line is that we're looking at something marvelous. If a soft landing occurs, well, let me take a break. Take a look at this graph. This graph is from the Brookings Institute, and it is a graph of a normal yield curve. This is what interest rates should normally look like in a healthy economy, and that is on the short end, when you're loaning money for short time periods, you get paid a smaller amount of money. And because of the time value of money, when you loan farther, like let's say 30 years, you get paid a higher interest rate. That's what a healthy, normal yield curve looks like. And it's market driven most of the time. And it indicates that we're just chugging along. As you can see, it artificially got lower and lower until finally around 2022, it was extremely flat, which was an indication in its own right that the Federal Reserve was stoking the money supply. Now here's an example, and I believe this is from the U.S. Bank. This is an inverted yield curve, and it's the yield curve earlier in July. And you can see that the situation is reversed. You're actually getting a higher return for shorter term investments. What that indicates is that money's tight. The demand for money is relatively high and it's more dear, and so people are willing to pay more for that money. That's usually an indication that the Federal Reserve has reduced the money supply in a variety of ways, and they're artificially boosting the interest rate and the cost of money, and thus a recession is likely to happen because all of a sudden expenses have gone up. They do that to slow down the economy. Inverted yield curves don't last. They almost always cause a recession, but right now we seem to be avoiding a recession. We seem to be having a situation where we're going to slow down the economy and reduce inflation without actually going negative. Now, last month, in last month's video, when I talked about the first half of 2024, I talked about the fact that there's a tremendous lag. And so we really don't know that we're going to avoid a recession, but it's looking very good, and the numbers seem very on the numbers are spot on. So this implies several things. The first thing is that if that happens, there's probably going to be a valuation-oriented correction in the stock market, and we'll get into that in a coming video. I mean, probably, not certainly. But the overall economic climate for investing in the undervalued or the fairly valued sectors of the stock market, such as international and small stocks, they're becoming more attractive if we're not going to have to go through a grueling recession. Now, take a look at this graph. This is from Mark Holbert's column. This is what happens when money supply is curtailed, as it has been in the last several years. And when that happens, the next 10 years are pretty challenging for the S&P 500. But as we discussed in our last video, the S&P 500 right now is 33% the top 10 stocks. So really, that overvalued sector of the market could get pummeled rather severely, and we'd all come out just fine. After all, one of the features of this declining interest rate and interest rate cuts in September and overall lower cost of money is going to be that our bonds make money. So this is going to be a tide that raises all boats if it happens. I'm always a little skeptical. And one last thing. This is from xe.com. This is the dollar versus the yen. The dollar should naturally fall versus other foreign currencies as interest rates make investing in dollars less attractive, as interest rates come down. So this is a sweet spot to gradually grow a little bit of investing carefully, moderately, mindfully in internationals and in the smaller sector of the markets and in the value side, all of which are fairly or undervalued. So you'll see that going forward if we don't have a recession. Give me a call. Let me know what you think. Right now, looking like a soft landing is on the way. Next, let's talk about valuation. Blessings.